Most people investing in Europe are making the same 3 mistakes. And the worst part? Nobody tells you this when you open a broker account. I am going to walk you through exactly how to build a diversified investment portfolio from zero. Plain language, no jargon, no boring parts. By the end of this video, you will have a clear and simple plan you can actually start this weekend. Stay until the end, because mistake number 3 is the one that costs people the most money. Let us get into it. Let us start with the basics. What does diversification actually mean? Diversification simply means not putting all your eggs in one basket. That is literally it. But here is what most beginners get wrong. They think buying 5 different stocks means they are diversified. It does not. If all 5 of those companies are in the technology sector and tech crashes, every single one of your investments drops at the same time. You have not spread your risk at all. Real diversification means spreading your money across 3 different dimensions. The first dimension is asset type. This means owning both stocks and bonds. Stocks grow your money over time but can be volatile. Bonds are more stable and tend to hold their value when stocks drop. Owning both smooths out the bumps. The second dimension is geography. This means owning companies from different parts of the world. The United States, Europe, Asia, and emerging markets all perform differently at different times. When one region struggles, another often does well. The third dimension is sector. This means owning companies from different industries. Technology, healthcare, consumer goods, energy, and finance all move differently. Spreading across sectors protects you when one industry has a bad year. Here is the best part. You do not need to research hundreds of companies or buy dozens of different investments to achieve all of this. You can get full diversification across all 3 dimensions with just 2 or 3 ETFs. That is exactly what we are going to cover next. Before we go further, let us make sure we are all clear on what an ETF actually is, because everything in this video depends on understanding this one concept. ETF stands for Exchange Traded Fund. Think of it as a basket. Inside that basket are hundreds or even thousands of different company stocks, all bundled together into one single investment. When you buy 1 share of an ETF, you instantly own a tiny piece of every single company inside that basket. The most popular ETF for European investors is called VWCE. This one fund contains over 3,700 companies from more than 50 countries around the world. Technology companies, healthcare companies, consumer brands, financial firms, all of them in one purchase. Why does this matter? Because instead of researching 3,000 companies and deciding which ones to buy, you simply buy VWCE and you own all of them automatically. The fund rebalances itself. You do not have to do anything. This is why index funds and ETFs have outperformed the majority of professional fund managers over the last 30 years. Not because the managers are bad at their jobs, but because the costs are lower and the diversification is broader. Now let us build your actual portfolio. I am going to give you 3 building blocks. You do not need all 3. Even just the first one puts you ahead of most people who have never invested before. Building block 1 is your core holding. This is VWCE. It covers global stocks across all regions and sectors. This is the engine of your portfolio. It is where your long-term growth comes from. For most beginners, this single fund is all you need to start. Building block 2 is optional. It is a European home bias fund. Something like MED, which focuses specifically on European companies. The reason some investors add this is that they already live, work, and earn in euros. Adding a little extra European exposure can reduce the impact of currency fluctuations on your overall returns. This is optional and more relevant as your portfolio grows larger. Building block 3 is your cushion. This is a bond ETF. A good starting point is AGGH, which is a global bond fund. Bonds behave differently from stocks. When stock markets fall, bonds often hold steady or even increase in value. Adding bonds to your portfolio reduces your overall volatility. The trade-off is slightly lower long-term returns, but much smoother ride along the way. For a complete beginner, The simplest starting portfolio is this: 80% in VWCE and 20% in AGGH. That is 2 funds. That is it. You are globally diversified across thousands of companies and protected by a bond cushion in one simple structure. Let us make this real with actual numbers, because this is where it gets exciting. Imagine you are 30 years old and you invest €200 or dollars a month into VWCE starting today. You set up an automatic monthly transfer and you never think about it again. At 7% average annual return, which is the long-term historical average for a global index fund, here is what happens to your money over time. After 10 years, you will have invested $24,000. But your portfolio will be worth around $34,000. That extra $10,000 came purely from compound interest, not from any extra money you put in. After 20 years, you will have invested $48,000. Your portfolio will be worth around $98,000. You have almost doubled your money through compounding alone. After 30 years, you will have invested $72,000. Your portfolio will be worth around €227,000. That is more than 3 times what you put in. From just $200 a month. No stock picking, no timing the market, no financial expertise required. Now here's the number that should really motivate you to start today rather than later. If you waited just 5 years before starting that same investment with the same monthly amount and the same returns, you would end up with around $158,000 instead of $227,000. That 5-year delay costs you nearly €70,000, not because you invested less, simply because compound interest had 5 fewer years to work. This is why starting matters more than starting perfectly. A small amount invested today is worth more than a large amount invested later. Now let us talk about the 3 mistakes. These are the things nobody warns you about when you first open a broker account. Mistake number 1 is buying US-listed ETFs. This is very common for people who do their research on American finance YouTube channels or websites. They see popular ETFs like VOO or VTI recommended everywhere and try to buy them. But if you are a retail investor living in Europe, you cannot legally purchase most US-listed ETFs. European regulations require retail investors to only buy funds with a UCITS label. UCITS stands for Undertakings for Collective Investment in Transferable Securities. You do not need to remember that. You just need to check that any ETF you buy has UCITS in its name or description. VWCE is UCITS compliant. That is why we recommend it. Mistake number 2 is ignoring currency risk. If you buy a fund that is priced in US dollars and the dollar weakens against the euro, your returns shrink even if the fund itself performed well. Many investors do not realize this until they check their portfolio and wonder why their returns look lower than expected. Currency-hedged versions of funds exist, but they charge slightly higher fees. For long-term investing, most people accept the currency risk because over 30 years, currency fluctuations tend to even out. But it is important to understand this exists. Mistake number 3 is trying to time the market. This is the most expensive mistake and the one almost every beginner makes at least once. It looks like this. The market drops and you panic and sell, locking in your losses. The market recovers and you wait for it to drop again before buying back in. It keeps going up and you miss the recovery entirely. Studies consistently show that missing just the 10 best trading days in a decade can cut your long-term returns in half. Those best days almost always happen right after the worst days, when most people are too scared to be invested. The solution is simple. Invest the same amount every single month regardless of what the market is doing. This strategy is called dollar cost averaging. When prices are high, you buy fewer shares. When prices are low, you automatically buy more shares at a discount. Over time, this smooths out your average purchase price and removes the emotional temptation to time the market. Now let us talk about the practical step of actually buying these ETFs if you are based in the Netherlands or anywhere in Europe. The two brokers most Dutch investors use are DeGiro and Interactive Brokers, also known as IBKR. DeGiro is the most popular starting point for Dutch beginners. It has a clean and simple interface, very low transaction fees, and it is regulated by the Dutch financial authority AFM. The main thing to watch out for is custody fees on certain funds. VWCE falls under DeGiro's free ETF selection on certain days of the month, which can reduce your costs further. Check their website for the current free ETF list. Interactive Brokers is slightly more complex to set up and navigate, but offers more flexibility and is often better for larger portfolios. It also has very competitive currency conversion fees, which matters if you are investing in funds priced in different currencies. Both brokers are regulated, and both are solid choices. My recommendation for a complete beginner is to start with DeGiro. Get comfortable with the process of buying ETFs, and then consider moving to Interactive Brokers as your portfolio grows. The single most important practical step you can take today is this. Open your broker account, set up a monthly automatic investment of whatever amount you can afford, point it at VWCE, and then leave it alone. Do not check it every day. Do not panic when it drops. Just let compound interest do its work. So let us recap everything we covered today. Diversification means spreading your money across different asset types, regions, and sectors. You can achieve full diversification with just 2 ETFs, VWCE as your global stock core and AGGH as your bond cushion. The simplest starting portfolio is 80% VWCE and 20% AGGH. Avoid US-listed ETFs and look for the UCITS label. Invest the same amount every month and never try to time the market. Start today rather than waiting for the perfect moment. That is the entire strategy. It is simple. It is boring. And boring is exactly what makes it work. If you want to go even deeper, my previous video compares VWCE and IWDA head-to-head so you can decide which one suits you better. The link is in the description. If this video helped you in any way, please subscribe. We make finance fun here at Quiet Money, or at least we try our best. See you next week.